Our next presenter began his professional career at Ned Group Investments. It's an asset management house. And thereafter, he joined the Competition Commission, specializing in competition economics and industrial policy. He then served as an economist at Standard Bank, where he played an instrumental role in setting up the bank's consumer and property economics unit. He then joined FNB in January 2019, where he focuses on the consumer and property economics. He holds an MCom in economics from Wits University. His name is Siphamandla Mkhwanazi, and he is the senior economist at FNB. Welcome, Siphamandla. It's always wonderful having you. And we look forward to your valuable analysis and predictions on the macro economy and also the resi market. So over to you.
Yeah, thanks, Neil. I look forward to it as well. Just my opening remarks we have seen that the pandemic has had a profound impact on global economic activity. We've seen that many economies experienced sharp recessions, unemployment spiked, and incomes stagnated. Yet we see that housing markets in major economies remain relatively unimpacted. We see that, for example, buying activity remains robust. Prices continue climbing. For example, in the UK, they just registered their highest number of mortgage approvals, sitting at around 91,500 in September, which is the highest level since 2007. And all of this is happening while infections continue rising, labor markets continue weakening, economic recovery loses steam. So this decoupling between the real economic activity as well as the housing market activity is in most parts facilitated by the sizable stimulus packages, both fiscal as well as monetary, that were initially designed to fend off the wider economic calamity. For instance, and in particular, the ultra low interest rates have made monthly mortgage payments much more affordable than houses, much more attractive to buy, and this appears to have stoked demand. And on the other hand, we've seen that mortgage repayment holidays in SA and in other parts of the world have saved thousands of jobless workers from having to sell their property or having to sell their homes, and this sort of prevented a major supply glut. And naturally, we see that these factors by their nature are price supportive, and which is why we are seeing price inflation in some parts of the world. And South Africa is not too different. And we'll go into this detail as we go along in the presentation. Maybe the starting point is to look at the economic backdrop. I'm glad my colleague Erwin did touch on this a bit, so I don't have to over elaborate on this. But importantly, which will lay a nice ground for us to assess what the property market is doing at the moment. We all know that, as I've mentioned again, that unemployment spiked. In the third quarter, we see that, however, so in the second quarter, there were about 2.2 million jobs that were lost. In the third quarter, part of those jobs did come back. Employment did improve by around 543,000. So a slight improvement, but still, we are still in the doldrums. If you think of employment as demand pull for the property market, it definitely has shrunk in 2020, both the home buying market as well as the rental market. Unemployment sitting at 30.8%. Year to date, 2020, we've lost around about 1 million formal employment, which is where most of funded institutions play. And our initial forecast was 1.2 million jobs lost. So we are tracking. So the outcomes are tracking our forecast, and this pressure in the labor market is likely to extend into 2021, particularly in the first half of the year, when corporates start picking up the pieces and they start talking about cutting costs and achieving those efficiencies. And when that happens, we think that we are likely to then start seeing more job losses. But the composition of those job losses might be slightly different. If you look at that chart, a very important chart, on the bottom right there of your screen, it breaks down employment losses by occupation. And what you see there is very interesting, that the impact appears to have been disproportionately disproportionately distributed at the moment. Your low skill and low pay occupations seem to be more severely impacted. Look at domestic workers, look at clerks, plant machinery. The amount of jobs that we have lost in those segments, mid-skill and more higher paying occupations. I want us to focus specifically on that professional occupation. So this is your white collar occupation. There we find quite interestingly that we actually created more employment for such for professionals in the middle of the pandemic. And this could explain the differences. This could explain the kind of activity that we are seeing in the property market, particularly if you look at the low end versus the middle end, the higher end of the market. So the first round of job losses had much more severe impact on the lower end of the market. The middle segment appears to be relatively insulated up to so far. That's where most of the professionals are concentrated. And the higher end of the market, which we will break down as we go along, is actually affected by non-labor market pressures, income pressures, such as pressure on rental income, pressure on dividends, pressure on profit, because a lot of them are self-employed. So they're dealing with quite a different set of pressures there. But we see that outcomes are disproportionately distributed, as I've just mentioned. Now, I will delve deeper into the property market in the next slide. Just general observations. I've mentioned that we see this decoupling between economic activity and the housing market. It's definitely playing out in South Africa in the last few months. We've started seeing a reflation in house prices, although still muted, so it remaining below inflation. So in real terms, it continues to decline. But overall, the impact of the pandemic has not been as bad as initially anticipated. And I think the saving grace this time around was the aggressively low interest rate, which appears to have incentivized renters to buy property. So this improved affordability. And for those who are lucky enough to have remained employed, remember in my previous slide, I spoke of professionals who up to so far have been relatively unimpacted by job losses. That is in relative terms, of course. We are seeing a lot of them. So their affordability is improving. We're seeing a lot of them switching from renting to owning. So if you think about it, really, it's not brand new demand. So for you to see brand new demand, you need to see two things. Number one, you need to see massive employment creation. Two, you need to see massive inflow of skilled migrants who would come into the country and, of course, demand property because they need shelter over there. They need a roof over their head. But we are not seeing any of that at the moment. So it's not brand new demand. As I've mentioned, all that we are seeing really in the home buying market is a switch from renting to owning. And this explains why we are seeing, which my colleague also spoke about at length, the rising vacancy rates in the property in the rental market, the subdued inflation in the rental market. It's all due to this diversion of demand away from renting to buying. But of course, that comes with very important questions about the sustainability. Is this going to be sustained? Of course, if we're not creating new demand, it means that it is going to run out of steam at some point. It's mainly driven, as I've mentioned, by the aggressively low interest rates, good prices in some suburbs, so with property prices declining in real terms. It's also driven by the lower transfer duties. It might have assisted, as well as the fact that there are these changing housing needs as a result of life. Under lockdown, we're seeing a lot of people having to reassess or re-examine their housing needs. We are seeing demand growing specifically for different types of properties. We are seeing demand for freestanding homes starting to rise, or in the case of sectional titles, it's those ground ground level flats that offer more space for gardening, because now households are assessing that their living spaces will have to double up as an office as well as a living space. So an environment conducive for both for living as well as for working from home. So overall, the impact of the pandemic is much more visible in the rental market relative to the home buying market. But as I said, jury is still out on the sustainability of all of this. Now, if you break down this house price growth by price segment, we loosely call these price segments. So what we've done here in these two charts is that we have taken all FNB's transactional data for the third quarter of this year, and we've broken it down into 5 equal pieces, so each containing 20% of the price distribution. So we did this to try to avoid having to come up with price segments ourselves, because there'll be a lot of questions around that. Why 750 and not 650? So we just let the data dictate to us where those boundaries are. So in this particular instance, we broke it down into 5 equal buckets, each containing 20% of the price distribution, with Q1, quintal 1, containing the bottom 20%, and Q5, quintal 5, containing the upper 20% of the price distribution, using FNB's transactional data up to the third quarter of this year. And what you see there is what has already been said, that generally the lower the price, the higher the growth rate. So in other words, I have said that we saw much more pressure, labor market pressure, in the lower end of the market relative to the higher end of the market, the middle and the higher end of the market. But what we are seeing here is that did not translate into weaker price growth. Yes, it has been coming down a bit, but it is much stronger than elsewhere. You are seeing much stronger growth in the lower end of the market, particularly for properties that have an average purchase price of around 473, which is your bottom 20%. But also followed by properties that are selling at around 540, which is your the second your Q2. So in short, that growth is concentrated, price growth is concentrated in the bottom 40% of the price distribution. We did see some improvement in the middle of price distribution, but still below inflation. So in real terms, still declining. And in the higher end, we see the continuation of a decline in house prices. If you break down that Q5 into further detail, again, it's a similar kind of a pattern. The lower the price, you still get at least some price growth. And where we start seeing negative price growth, negative nominal price growth, is after that 2 million price bucket and upwards, and much more pressure in the luxury, let's call them the affluent or the wealthy segments. And as I've mentioned, this specific group of households is having to deal with non-labor market income pressures, pressure from rental income. I've mentioned that landlords at the moment are struggling to keep to hold on to their good tenants, because their good tenants are now preferring to buy property outright. They are also facing dividend income pressures, with a lot of companies not having declared a dividend due to the economic pressures that they are facing. Interest income as well, because interest rates are very low at the moment. So all of that pressure combined means that there is going to be that negative wealth effect, and we see that affecting the wealthy segments quite significantly. But it really is just a continuation of what was already there pre-pandemic. It's just exacerbated it, which means that the recovery that we were hoping for might be slightly delayed, particularly in this segment. Now, my colleagues, my two previous speakers, did touch on this a bit, and this is just to drive the point home that we are seeing a lot of activity at the moment. If you look at volume of applications, these are new, unique applications. Year to date, 9% above 2019 levels. A lot of this is happening while unemployment is reaching historical highs, while economic growth is at historical lows. But we are seeing this kind of activity. As I mentioned, it's demand that has already been there in the system. It's not necessarily brand new demand. But we also see that volume of approvals now is still lagging a bit behind in our assessment. And by the way, this is industry-wide data. This is not just FNB. Our assessment is that this is due to the uncertain economic outlook. So lenders are taking that cautious approach. Granted, because I mean, as you would expect with this uncertain economic outlook, you would expect lenders to take a bit of caution in approving mortgages. But even with that cautious approach, volume of approvals is still 1.5% year to date, 1.5% above the 2019 level. So between Jan and September this year, approvals are 1.5% higher than in the same period in 2019. So really, it's more than just a pent-up demand due to the closure of the deeds office at the height of lockdown, or we are really seeing new demand coming through. And as I mentioned, approval rates are still lagging a bit behind, but even there we are seeing an improvement. If you look at it at an industry-wide level, approval rate is now above the 5-year average. So there is an improvement there, also responding to the kind of demand that we are seeing at the moment. So really, demand and liquidity remained relatively intact during the pandemic, but as I have mentioned again, there is still a great deal of uncertainty around whether this will be sustained. If you look at loan to price or loan to value, you can interpret it as loan to value. It has been consistently increasing. That is a function of two things. Number one, the kind of demand that we are seeing at the moment, it's mainly driven by first-time buyers, those who are under the age of 35, and those kind of customers or those kind of buyers tend to have a higher reliance on credit to fund their acquisition. So I read this as partly a response to market demands. So lenders are responding to market demands because the kind of buyer, the kind of demand that we have to deal with at the moment dictates to us that those are the customers that need higher LTVs, and lenders, it appears that they are obliging, even though they have applied a slightly stricter lending during the pandemic due to this uncertain economic outlook. And the second factor why we are seeing this rising LTVs is the intense competition in the banking industry, particularly with apps trying to claw back some of their lost market share. Standard Bank as well. So there's that dynamic competition that is taking place in the market at the moment, which favors the buyer, of course. Lower mortgage rates, higher LTVs, and that has kept the market going even during the pandemic, and that has assisted the market, and it has meant that the kind of impact that many of us expected at the beginning of the pandemic did not materialize. So the market performed much better than initially feared. But what else the very low interest rates have done in the market is that inadvertently it's offered, or the improved affordability. What the improved affordability has done is that inadvertently it's offered sellers a bit more room to negotiate, right? Throughout 2019, we were talking about rising discounts on asking prices. So the difference between what is the initial asking price and what ends up being the final sale price in 2019, we saw an increase in that spread, which meant, or which indicated to us at least that it told us about the balance of market power. So sellers would have to cut their asking prices a bit more aggressively in order to facilitate the deal. To our surprise, since the beginning of the year, that average discount has pulled back, and our interpretation, it is due to the improved affordability, which has offered sellers a bit more room to negotiate. It's still elevated, but it's going in the opposite direction compared to what was initially expected. So sellers aren't as desperate to strike a deal. That's due to the improved affordability and the improved demand that we are seeing at the moment. With that said, market discounts remain relatively elevated, but not as bad as initially forecasted, and that means that also explains why we haven't seen as massive price declines that we initially anticipated. If you break it down by price buckets, you will see that the discounts are more elevated in the extreme ends of the market. In the lower end, the affordable, the market we crudely call affordable market, so property values below 750, slightly different from Alison's segmentation, but I mean, it's a matter of just segmentation. I think the trends are very similar. So in the extreme ends of the market, discounts remain relatively elevated, and that is due to the pressures I've just explained. But in the lower end of the market, it was more labor market pressure. It didn't come through in price growth, but it did come through in the level of activity as well as the incidence of downscaling due to financial pressure. So we saw it coming through in the lower end of the market. At the higher end, 3.6 million and upwards, I've already explained the negative wealth effects that those households have had to deal with. Next slide, please. And of course, the fact that the market is still relatively oversupplied in the higher end, although we did see, at least in the higher end, next slide please, I think there is a bit of animation there. Maybe let's can you just press next until we have the full chart there. I was explaining that in the higher end of the market, what we have seen really is so throughout 2019, there was this trend of immigration due to sale of property due to immigration. It increased quite strongly in 2019. We have started seeing a reversal of that. It affected mainly the higher end of the market. In 2020, what we are seeing in the higher end also is that sellers are preferring to pull their properties off the market, because I think they have assessed market conditions and determined that it's unlikely that they will get their desired price, so they have decided to pull them out of the market in favor of home improvements. So as a result, we are seeing robust sales of building material and hardware, glass and paint. It's due to mainly higher end or higher income households improving their living spaces, so they've withdrawn their properties off the market in favor of home improvement. So if we combine those two factors, the moderation of the immigration trend, as well as owners preferring to improve their homes rather than sell them outright, it means that yes, supply in the higher end of the market has contracted a bit, but the market still remains excessively supplied, or there's just still a lack of demand in those segments of the market, and hence the market is excessively supplied and prices are still subdued. Now that chart there shows that while there was a very quick recovery in market sentiment, in the extreme ends of the market, as I've already explained, it's been relatively subdued. Now, the last time we did this survey, these are results up to August this year. The expectation at that point in time was that the expectation of estate agents was that activity was going to start improving in the lower end of the market, presumably as lockdown restrictions are lifted and more sectors open and more people are able to go back to work. The expectation was that activity was going to start improving from that point onwards. I can confirm that looking at internal data, we have indeed started seeing over the past 2 months or so, activity in the lowest end of the market starting to pick up, catching up with the middle segment, but it's in relative terms it's still lower. So that improvement has indeed come through. But if you break down the affordable market a bit better, a bit more, you will find that there is that sweet market, that 250 to 500, where estate agents are seeing much more activity. There's much more exuberance there. There's so the market outlook is also much better compared to other price points. But overall, in the lower end of the market in particular, it was that activity was going to start picking up, and we have started seeing that, and that is in line with the lifting of lockdown restrictions. And at the higher end, I've explained in detail what they have to deal with. Next slide, please. But also, while we are talking about the trends at the high end of the market and the lower end of the market, what we've seen in the lower end is that at least the first wave of job losses that we have seen meant that there's a spike in downscaling incidents due to financial pressure. It's estimated at around 1 in 10, sort of 3 in 10 of every 3 in 10 of every properties that are sold in the lower end of the market are due to financial pressure. So it's sellers who are looking to downscale. But what we find there quite interestingly is that over 60% of those who sell due to financial pressure still come back to the market and look for a cheaper property. That speaks to the sentimental value that property holds in the lower end of the market. So it's not demand that is completely lost to the rental market. A lot of them still come back to the market and buy a cheaper property, of course, subject to the lack of alternatives that my colleague Alison spoke at length about, which is also why property price growth is much better in the lower end of the market. It's due to that systemic lack of supply, particularly new supply into the market. So there's that deficit of supply there. But what we're also seeing is that what also the estate agents are telling us is that while financial pressure has been mainly concentrated in the lower end of the market, that 2.6, 3.6 price bracket is also starting to see a pickup in sales due to financial pressure. So this pressure might well spread into higher priced segments, which indeed will have that dampening effect on activity, and of course continue to have a dampening effect on prices. So what really is happening, what really could happen is that what we saw throughout 2019 in rise of sales due to immigration, it might just be replaced by this financial pressure that is picking up there. So it's really just a substitution of immigration. Now we are going to probably start seeing financial pressure building through. And of course, we haven't built into our forecast the impact or the likely positive impact of the economic the reconstruction of the economy that was announced by the president about a month ago. In closing, next slide. In closing, so our view really is that while we have been positively surprised by the kind of activity that we are seeing right now that has assisted property price growth, our assessment of the labor market suggests that we could see more pressure in the medium term as those job losses extend to your typical white collar occupations, and that is your typical buyer in the property market. So our view is that in the medium term, at least, we are likely to see more pressure on price growth, and especially because the kind of activity we are seeing right now is driven by lower interest rates, and it's known that those are cyclical, and the impact of which wanes as time goes on. But what we think are supporting factors are, I've mentioned, lower interest rates for longer. Yes, we do think that there will be pressure to hike interest rates in the next 18 months or so, but we don't think, even under those scenarios, we don't think that the hikes will be as aggressive as the cuts were. So really, in our view, it will take us a very, very long time before we get to interest rate levels that we were in January this year. If there's pressure to hike, it's at most going to be kept at 50 basis points. But our view at first read is that we are going to probably see one last cut in interest rates because of the subdued economic growth, subdued inflation. We think that inflation will surprise to the downside, so which will create space for one last cut in interest rate, and also the rise in sovereign risk limits or reduces the probability of that cut. But with all considered, the balance of probabilities, we are still tilted towards a last 25 bips cut in interest rate, likely in January next year, and then flat throughout the forecast horizon all the way to 2022. We do acknowledge that there will be pressure to hike, but we don't think that the hikes will be as aggressive as the cuts were. It will take us a long time before we get to the January interest rate level. So those are the supporting factors. And of course, the efforts to reignite economic activity. If those boost sentiment and employment, of course, outcomes might be slightly better than what we have presented here. But really, in our view, we are not out of the woods yet. In the medium term, we are likely to start seeing that financial pressure creeping up and spreading into higher income households, and that is the dampening effect on activity and by extension on price. I will stop there, Neil, and I'm happy to take questions.
Wonderful. Thank you, Siphamandla. Well, this is also going to be the start now of the panel discussion, and there is lots of questions that have come flying through. And so, yes, absolutely, we're going to deal with them right now.